events in Ukraine and, from the very narrow perspective of financial markets, the war's effect upon commodity prices in particular continue to grab the headlines, and the conflict is likely to overshadow pretty much anything else. But investors will no doubt keep an eye on the spring statement from Chancellor of the Exchequer Rishi Sunak on Wednesday, the 23rd of March, and that's also the scheduled release date of February's inflation figures here in the UK. Now, the Bank of England has a target of keeping inflation at around 2% year on year. And after a good decade of pretty much undershooting that goal, the old lady of Threadneedle Street is faced with a different challenge, namely how to rein it in now it's overshooting. This requires a tricky balancing act. If the Bank of England moves interest rates up too far too fast, then the heavily indebted UK economy could possibly hit the buffers. If it moves too slowly, then inflation could curb real-term spending power of workers' wages and hit corporate profit margins, impacting the willingness and ability of consumers to spend and companies to hire and invest. By way of a reminder, data from the Office for National Statistics showed that the annual rate of inflation was as follows back in January: 5.5% year on year, according to the Consumer Price Index or CPI, and that was the highest figure since this measure was introduced in 1997. 4.9% according to the CPIH, the Bank of England's preferred measure because it includes housing costs, and maybe also because it gives a consistently lower figure than CPI, and 7.8% for the Retail Price Index or RPI, which is no longer officially a recognised statistic, perhaps because it gives the highest measure consistently. Now, that RPI reading showed the fastest rate of increase since March 1991, when, lest it be forgotten, the Bank of England base rate was 12.375%, rather higher than it is today. Company-wise, well, there's a long list of firms slated to release full or half-year results or indeed a trading statement. Only a handful hail from the FTSE 100, and the others are mid or small cap firms. Names which may be worthy of further research because of what they say about themselves, their industry or the wider economy include the following, although there is still a chance that some of these dates prove to be subject to change. S3 on Monday the 21st of March, Kingfisher, Wood Group, Softcat, Staffline and Sabre Insurance on the 22nd, Halma, Saga, Henry Boot and Dignity on the 23rd, Sophion, CVS, Bridgepoint and Pendragon on the 24th, and Smiths Group and United Utilities will round out the week on Friday the 25th. However, the company which could just cause the biggest fuss in the week ahead is Next. The multi-channel retailer is set to publish its full year results for the 12 months to the end of January on Thursday the 24th. Now, Next shares are down by almost a fifth over the past year and by a quarter from their December all-time high. The share price slide may reflect concerns of a possible supply chain disruption, input cost and wage increases and the effect of those on margins, and also how inflation continues to creep up, high fuel and energy prices and higher interest rates, and how all of that could impact consumer confidence and shoppers' willingness and ability to spend. Even the third quarter statement in November and the Christmas update in the first week of January have not stemmed the tide, even if both read very well. Next's festive trading statement revealed that the financial year had ended more strongly than management had anticipated, despite the outbreak of the Omicron variant. Strong full price sales and price increases both helped, especially as strong volumes left Next with less excess stock to shift and lowered the need to cut prices on that inventory to get rid of it. The stronger than expected sales prompted Chief Executive Lord Simon Wolfson to upgrade his estimates for pre-tax profit for the year to £822 million, and that compared to initial guidance of a year ago of £700 million. It also compares to the £342 million actually made in the pandemic-hit 12-month period to January 2021. Yet, the shares seem to have decided that they've priced in and looked through all of that good news. The real key may therefore be any update on guidance for the year to January 2023, where Next's initial steer is for 7% full price sales growth and a 5% increase in pre-tax profits to £860 million. Watch here again for any comments on input cost inflation and pricing. Next flagged a 5.4% increase in its wage bill for the year just ended, but it noted it responded with price increases of 3.7% for spring-summer and 6.6% for the autumn-winter collection last year. Also look out for any comments on capital investment. Next spent £190 million in the year just ended, against its initial budget of £135 million, thanks mainly to spending on warehousing capacity and the associated systems and IT. Finally, analysts and shareholders will look out for an update on the plans to return what Next terms excess cash to shareholders. The FTSE 100 firm paid out £140 million, or 110p a share, on the 3rd of September, and then paid out a higher than expected £205 million, or 160p a share, at the end of January. For the new financial year just begun, Next is looking to resume ordinary dividend payments when the current consensus forecast is for a distribution of 218 pence a share. Analysts and shareholders may also ponder the resumption of share buybacks as well, although it could be yet too early in the year for Lord Wolfson to comment upon that. The retailer's paid out around £2.3 billion in dividends and £1.9 billion in buybacks over the past decade. Those buybacks have taken the share count down from 181 million shares to around 127 million, but please note the discipline that Next brings to buybacks. It doesn't buy back stock willy-nilly at any price like so many of its FTSE 100 peers. It buys back stock when the purchase brings in an equivalent rate of return, or ERR, of 8%, and it calculates ERR by dividing pre-tax profit by the market capitalisation. The company's market cap is £7.8 billion as I sit here, so the ERR implied by Lord Wolfson's guidance for pre-tax profit of around 860 million, well, that implies an ERR of 11%. So watch this space. I hope that you and your families are in good health and good spirits. Thank you for watching, and I look forward to seeing you next time.